Hello and welcome to our market alert video for today, which is Friday the 13th, 2024. I hope this video is reaching you healthy, wealthy, and wise. I am Ken Moraif, the CEO and founder of Retirement Planners of America, and we have a singular goal, which is to create as many squippers as we possibly can. And if you don't know what Squippers is, well, Squippers is the acronym for Second Childhood Without Parental Supervision. That's our goal. When a client of ours retires, we call them a Squipper, and we want them to get out of here, go play, have fun. And so we want to create as many Squippers as we possibly can. Our website is rpoa.com. And I want to dive into, we've got some important data that came out on the inflation front and what we think is going to happen going into the rest of this year. But before we do that, I want to share with you a quick story. We have a dog, her name is Noodle, and she's a 75-pound Schnauzer Poodle blend. Okay, so she's a schnoodle, and we call her Noodle. So she's Noodle the schnoodle. Anyway, so we were having a dinner party and we had steaks. We were expecting 16 people, so we had steaks on the counter, salted the steaks, put spices in them. They were all sitting there getting ready to be put on the barbecue. And I'm sitting there doing, making a mix or something, and I hear all this mastication. I hear, and I look over, and Noodle had grabbed 3 of the steaks, and before I could get over there, she inhaled them. Now remember, she's 75 pounds. She's a big dog. Her nose, her chin is like on the counter. I guess it was just a little too much of a temptation for her to resist. Anyway, so we got data this week on the inflation front, and it looks like inflation continues to cool, which is a good sign. So now what's happening is the Fed is going to change its focus from getting inflation down to making sure that the employment numbers don't go crazy and we start seeing massive unemployment and a big bad recession. Because remember, they have a dual mandate. One is to keep inflation under control, and second is to have employment at a good number. So those are their 2 mandates, and now they're kind of switching from the first mandate to the second. Now, we anticipate that next week on the 18th, when they meet, that they're going to lower interest rates by 25 basis points. That's in the business, 1/4% is called 25 basis points. Now, there's some talk that they might go 50 basis points. Now, we don't think they're going to do that, and the reason why is because what the Fed does not want to do is scare the market. Okay, if they go big, if they go 50 basis points, investors are going to say, wait a second, why are they doing that? Do they know something we don't? Should we be panicking? Should we sell? They don't want it. They want everybody to be calm. We need calm markets. So we anticipate it'll be a 25 basis point cut. So this is also what we forecasted. At the beginning of this year, we said that the Fed would not be lowering interest rates until the second half of this year. Many of the biggest banks were saying in March of this year, 6 months ago, that they were, the Fed was going to lower interest rates starting in March, and 7 cuts even. Wow. And we said, no, we don't think so. Second half of the year, and sure enough, that's where it's happening. Now, we also said that in the second half of this year that bonds would outperform stocks. Now, why did we say that? Well, because as the economy slows and as concerns about profits mount, the stock market gets very bumpy, right? So it's an arm wrestling match, and we've seen that. It's up a lot, down a lot. It's like it's going sideways, but a lot of activity in between. So we anticipated that the stock market would underperform bonds. Now, bonds, why would they do so well? Well, we think we're going to see a historic rise in bonds because they had a historic drop back in 2022 when the worst bear market in bond history, according to Bloomberg, happened. And by the way, just so you know, on this video, we said in April of 2022, sell all your bonds. That's what we did for our clients, which is why I always say, if you don't watch this video, you do it at your own peril. So for those of you who followed our advice, you missed out on most of the worst bear market in bonds in history. We then said to buy back in December of last year of 23. So we were out for, a year and 8 months or so, and out of bonds, and turned out to be a good move. Now, we bought back in December in anticipation of this being the year where the Fed lowers interest rates. And sure enough, that's exactly what's been happening. And so that's why we think that into the rest of this year, that the bond market will outperform the stock market, because as the Fed lowers interest rates, And we could see them lower them again in November and December, so maybe 3 cuts this year. And bonds love that, and they should do well as they already have been, and they have been doing better than stocks as we forecasted. So, that's all so far so good. Now, for those of you who didn't watch our video last week, I highly encourage you to go back and watch it. I had Jordan Roach on with me. He is our investment oversight committee director, and he went over with what has happened in the last 10 election cycles. And in 8 of them, we saw a correction, which is a drop in the market of more than 10%, but not 20. Okay, so that's a correction. And in all 8 of those cases, there was the correction. It was scary, unpleasant, but the market recovered into the end of the year. So we anticipate a correction this year as well. And we see it as a buying opportunity for stocks, not as a reason to panic and sell and get out. Okay, so we anticipate that coming at the same time. So that's what the rest of this year looks like from here. Now, the other thing that I want to reiterate is that we believe that you should always plan for the worst and hope for the best. Don't plan for the best and hope the worst doesn't happen. That's not very prudent, especially when you're managing other people's money, as we do. And we work with over 6,500 beautiful, wonderful families across the country, and it's quite a responsibility. So we always want to protect principal, right? We believe growth is important, but protection of principal is even more important. And that's why we have a strategy to address if we're wrong. And the market takes a big drop like it did in 2008 and goes down more than 50%. We want to protect our clients from that. And that's why we have our invest and protect strategy in place. It told us to sell, speaking of 2008, in November of 2007, okay, a year before Lehman collapsed. And certainly we were out for all of 2008 and half of 2009. It wasn't until June of 2009 before we bought back in. And so avoiding those big losses is very important to us. We work with people who are over 50, who are retired or retiring soon. And we believe that protection of principal is job number 1. Yes, we want to grow. Yes, we want income. But you got to have your nest egg there to provide all of that. And if you don't have it, you lost it, then you have to live to fight another day. So our goal, as I mentioned, is to create squippers. Squippers are people who are enjoying their second childhood without parental supervision. So when a client of ours retires, that's what we call them. And if you're not a client and you'd like to learn more, make sure you check out our website. It's rpoa.com. So for now, the forecast looks like it's going to be bumpy on the stock market, great on the bond market, but buying opportunity most likely will be coming from stocks. So thank you for watching this video. Share it with your friends. Make sure you subscribe. You don't want to miss it ever. Last week, we talked about important stuff. We talked about the interest rates. You don't want to miss a single one of these. So make sure you subscribe, and we'll talk soon.